Hey everybody, welcome to Wall Street for Main Street podcast. My name is Mo Daoud and today's guest is Brent Johnson. He is the CEO of Santiago Capital. Brent, thank you for joining me.
Absolutely. Thanks for having me. Looking forward to speaking with you today.
So Brent, for people out there that haven't heard from you before or have never heard of you, could you give us a little background about yourself and what you do? And
Yeah, absolutely. So I used to work at a firm called Credit Suisse, for almost a decade, from the late 90s through the end of 2009. And I was in their, high net worth group in San Francisco, mainly advising, high net worth individuals on their personal portfolios. Subsequent to 2009, I left Credit Suisse, and we can kind of go through over why I did that if you want to get into that in more detail. But I joined a friend of mine who had started his own wealth management firm called Baker Avenue Asset Management. So I still do that. I'm still part of Baker Avenue. But then also in 2012, I set up Santiago Capital, which is a separate legal entity, and I set that up as the precious metal solution for my clients' overall portfolio. So I'm a little bit of both things. I'm a little bit of an overall, strategist, investment advisor, but then have a specialty in the precious metals arena as well.
so, if you don't mind asking, why did you leave Credit Suisse? Is it something to do with what happened during the financial crisis?
Yeah, it was kind of a funny thing because I had my dream job. I'd always wanted to work for a big firm. Credit Suisse was kind of my number one choice. I always wanted to live in a big city and, kind of a world-class financial hub. And, San Francisco was one of those. And, I always wanted to work, in kind of the high net worth arena. So I kind of had my dream job with my dream firm, was making good money, and, life is pretty good. And, without going into too much detail, a couple things happened in late 2007, early 2008, to where I kind of started seeing the world a little bit differently than, I guess the firm as a whole. I'm not going to say I predicted the financial crisis because that wasn't the case, but I certainly had some questions about what was going on and whether it was sustainable. But never throughout that process did our chief investment officer, our head of equities, or any of the, the big global experts, never once did they say, hey, maybe we should reduce exposure, or hey, maybe this isn't a good time to be in equities. And, I kind of had a disagreement with my boss, so to speak, over the road we should take ahead. And, the basic answer was that your job is not to be the investment advisor. Your job is to sell products. And, that just didn't really sit really well with me. And so at the end of 2009, we were coming out of the financial crisis. Credit Suisse had actually come through it fairly well. And I kind of went back to them and said, well, what did we learn? This obviously didn't go the way everybody thought it was going to. And, what are we going to do different going forward? And, the basic answer was, well, thank God we made through it. It's back to business as usual. And, that just wasn't something that I could live with and continue to do. And so I kind of had a, situation where I thought I was in my dream position, and it turned out that I hated it. But I still liked my clients. I still liked doing what I did. I needed to find a new place to do it. And so, the natural progression was to find a new place. But going to one of the other big Wall Street firms, I'd be right back in the same position. So, I kind of left Wall Street proper, so to speak, and joined an independent firm, and had a little bit different vision of the right way to, structure client portfolios and a way to manage them in what was becoming an increasingly risky world. So that was the impetus of the move there.
Yeah, and thanks to the creation of the Federal Reserve, Wall Street banks just went back to business after the 2009 financial crisis, because they know if something happens again, they'll get bailed out and everything will be okay for them. So they go back to their business practices that they've done before the financial crisis.
Yeah, at the end of the day, you can dress it up with fancy language and explain what it is in different ways, but at the end of the day, the Federal Reserve is, at the end of the day, it's a trade federation for the banks. It's their job is to look after the banks and make sure the banking system stays in business, and that any losses become nationalized and any profits go to the bank. So, that may not be a popular opinion of the way it is, but at the end of the day, that's really what it comes down to.
That's very unfortunate. So how did you get in the gold market? There's something that happened that got you interested in the gold market?
Yeah, well, I kind of we'd always had some kind of an allocation towards precious metals, but it's always been, very small, 1%, 2%. Maybe we'd have an occasional individual gold mining stock in a portfolio. This was early 2000s, even in the mid 2000s. But as we got closer to 2008, and I kind of had this pivotal meeting in my career where I kind of saw the light, so to speak, and I really kind of had the light bulb above the head moment where things really crystallized in me as far as the state of finances, not just from individual level or country or a corporation level, but from a country level, right? And I really for the first time understood the national debt and the deficits and all that stuff, and I realized it was just the debt was going to overwhelm everything else. And so around that time, I started trying to figure out what's the right solution. And, when you go through, at least me anyway, when I went through my education and I took finance classes and banking classes and, you learn about the central banks and you learn about money creation, for the lack of a better answer, I just memorized the way it worked. I didn't ever really question the way it worked. And, I guess I was smart enough to memorize it and so I could pass my test and et cetera, but when looking back on it, I probably didn't really quite understand it, in the early part of my career. And I would argue still that 99% of the people that work on Wall Street really don't understand the way the monetary system works. But anyway, 2006, 2007 time period, I started really kind of digging into how does that actually work and why does it work that way? And I kind of broke it all down into the mechanics of the monetary system. And that's when I really kind of got the full view. And, so like I said, when 2008 came along, I knew the debt was going to be a big problem. The debts on individual balance sheets, the debts on corporate balance sheets, and the debts on the national balance sheet. And, I didn't necessarily have the answers, but I knew it wasn't going to end well. And through that process, I kind of started learning more about gold. Obviously gold has no counterparty risk, so there was that aspect of it. And so, just through really trying to figure out what's going to be the solution to get clients through the next 5 or 10 years, as this crisis, so to speak, expanded, needed to figure out alternative methods to do that because I didn't think the traditional methods, sold on Wall Street were going to do the trick. And I guess as a natural progression, that kind of led me to, I don't know if you want to call it the Austrian school of investing or, the precious metals arena or more libertarian type thinking, et cetera. But that's really kind of how it all came about. And a lot of it was initially self-taught. But then, I started reaching out to industry experts and I started reading books that people recommended to me. And, over time, I actually met a lot of these people whose books I'd read or who I'd seen interviews of. And so it's really been a progression, and I'm still learning. I don't sit here and claim that I know everything by any means. I kind of feel like one of those, if you're not learning, you're not living anymore. So I certainly don't have it all figured out, but I think I have a pretty good handle on the way the system at least works now. And, the way some of the methods that you can use to kind of help protect you against that.
Yeah, and that's a pretty cool story. I met a lot of people that kind of changed their career after the financial crisis due to what, bad business practices that happened on Wall Street. So it's good to meet another guy like you.
Another part of it I should probably mention too is it just so happens that my wife and we had our son in the summer of 2008 as well. So as the world was crashing, financially, my world was expanding, on an individual level. And everybody always says it, it's very cliche, but when you have a kid, you see the world through different eyes. And that was definitely the truth with me. And so a lot of the policies that I saw being enacted, it made me think more about, well, what does this really mean? And what does it really mean for the future? And who's that going to benefit in the future? And who's it going to hurt in the future? And, in many ways, I saw the world that we're leaving for my son, and not just my son, but everybody else's kids as well. And, one of my friends recently said in an interview that, after 2008, we have a moral responsibility to kind of explain the way the system really works. And, I couldn't agree with him more. And that was really, to be honest, I'm a capitalist. I believe money is important. I believe money is the greatest invention ever made because it allows us to all specialize and, do the things we want to do rather than being hunter-gatherers. But at the end of the day, money's not the most important thing in the world, and there has to be about something more than just money. And, I really think that, I guess for those of us who see the world that way and kind of see what's being done, to a certain extent, we have a moral obligation to at least share what we're seeing with the rest of the world, and maybe help. If we help one person along the way, I guess it's worth it.
Right. Yeah, and I agree with you about the debt problem that we're having right now. It's like we're over leveraged in all areas in the economy, whether here in the United States, in the private sector, public sector, and also in other countries as well. And it's all due to the currency wars that's going on right now, where all the central banks are debasing their currencies.
That's right. Yeah, and the current. I think the first guy that came out and said it. Well, James Rickards been out there for 6 or 7 years now talking about the currency wars, and if people haven't read his books, they should absolutely read his books. I think it was the central banker from Brazil who I think it was 2010 or maybe 2011 came out and said, "Listen, we're people may not admit it, but we're in a currency war." And since that time, they haven't gone away, and in fact, they've heated up. And literally in the last 12 to 18 months, they've really been on fire, and I think that's only going to continue.
Yeah, a lot of interesting things that happened in the past couple of months. Japan doing negative interest rate. The Federal Reserve here in the United States is thinking about doing negative interest rate, and I'm sure other countries is thinking about it as well. So yeah, a lot of interesting developments happening in the global economy. So I want to talk about the Federal Reserve. Now, I read an article today, and I thought it very interesting, from a former Fed president that said that we injected cocaine and heroin, we as in the Federal Reserve, injected cocaine and heroin into the system to create a wealth effect.
Yeah.
It claimed that it doesn't fix anything, even though it provided short-term boost in the economy. And he's claiming that the Fed do not have any more ammunition. What's your thoughts on that?
Well, first of all, I think it's pretty funny that whenever a central banker leaves office, it's like they get a truth serum given to them on the way out, and all of a sudden they can actually start saying what really goes on, rather than what the typical Fed speak that comes out while they're still in office. And,
like Alan Greenspan.
Yeah, exactly. Now, I don't have. He's a perfect example, right? Before he was at the Fed, he was he kind of an avowed libertarian, and espoused the benefits of voting gold. For the whole time he was at the Fed, did nothing, to further that cause, and many times disparaged gold. And then now he's out, and he's made many pro gold comments, since being out of office. So Mervyn King's another one over in Europe. Seems like a lot of these central bankers, when they leave office, they I don't know if they have a come to Jesus or what it is, but I think what most people don't realize, and depends on which point of view you look at it from. If you look at it from the central banker's point of view, they have done a masterful job so far. I mean, they have convinced the world that their policies are necessary, that what they're doing is for the good of society, and that their actions are benevolent and altruistic, et cetera, et cetera. And from that perspective, they've been remarkably successful. Now, in the last, call it 6 months, some of that central bank omnipotence has started to kind of fade a little bit. And with the introduction of negative interest rates, it's certainly the shine is coming off the central bankers a little more. But the world as a whole still hangs on their every word. At the end of the day, they may say that it's for the benefit of the whole, but their first priority is the benefit of the banks. And so from that perspective, perhaps they gave the world cocaine and heroin to kind of induce them into a sleep, or to give them, the energy to go out and run and spend and, pump the economy up. But, in the long term, I don't think they did us any favors.
Yeah, and he said that the Fed don't have any more ammunition, but they haven't tried negative interest rate yet. So they have a little bit more ammunition that they could try to artificially boost the economy. So we'll see what they do with the negative interest rate.
I sort of disagree with him on that point. I think I know the point that he's trying to get across is that they've tried all the stuff, and the efficacy of these central bank policies is not having the same effect that it used to. But I certainly don't think they're out of bullets. I think there's a lot of things that they can still do, and I think they're going to do all of them. And I think ultimately that they're going to fail. I don't know that we're at the failing point yet. Like I said, the the shine of the central banker is definitely coming off. People are starting to question what they do rather than blindly accepting it. But I think if anybody thinks the central bankers at this point are impotent, or I think they're kidding themselves. I think there's a lot more things that can be done and will be done, and kind of heaven help us when it happens.
Yeah, maybe they'll go in the open market and start buying stocks in the Nasdaq or the S&P 500. They haven't done that yet.
Look at Japan. They're already buying ETFs. The Bank of Israel already buys ETFs. Draghi's coming out tomorrow. He's probably going to go more negative. May announce a new LTRO. Wouldn't surprise me if he comes out and starts buying ETFs. It's just kind of a natural progression. And I mean, at the end of the day, there's only two choices. You either because of the way the monetary system is designed. It's the same all over the world. It doesn't matter whether you're talking about the United States or China or Japan or Europe. It's a debt-based monetary system, and a debt-based monetary system has to grow. It's designed to grow. It does not have a reverse gear. If it reverses, the whole thing crashes down. So they really have two choices. They can three choices. They can let the whole thing go and let it come crumbling down, which they won't do. Or they can expand credit, right? And they can pump up the monetary system. You pay off the debt, you expand the debt, or you let it crash. They're not going to crash. They're not going to let it crash purposely. They can't pay it off, so they've got to expand the debt on a global basis. Now, maybe one country here or there can move to positive rates while the other one's going negative, but on a global basis, credit has to expand or the whole thing comes down.
Yeah, I agree with you there. I mean, our economy is being put together with bubble gum and duct tape and paperclip right now.
Yeah.
And one black swan event can make the whole thing burst. So that's how fragile the economy is right now. And it's mainly because the fundamentals of the economy is not very strong, and that's productive job. There's no capital formation right now in this country. There's no saving.
Right.
There's no saving because inflation is high and people can't save money, and plus not enough jobs out there right now. A lot of people are jobless.
That's right. Yeah, it's kind of the heart of capitalism is savings, right? And a lot of people don't understand that, but without savings you don't have a strong economy, and the world is clearly in a negative savings environment, and that can lead to phenomenal growth, but it will eventually lead to a phenomenal crash, and that's we're due to have one. We had one in 2008, and then I don't think people realize, 2008, obviously everybody knows, but I don't think people realize how close the system came to the edge in 2011 at the peak of the European, sovereign crisis, when Portugal was about ready to go down, Italy was about ready to go down, Greece, Ireland. That, I think, got us as close to the edge as 2008 did. But regardless, we've had two times in the last, 8 years where we came right up to the edge, and the central bankers were able to, pull it back from the cliff, so to speak. But the problems haven't gone away. They've just been pushed down the road. So,
right.
Whether we come upon them again tomorrow or a week from now or 2 years from now, my crystal ball isn't quite that clear, but I do know that we're going to come upon them again.
Right. So there's been a lot of volatility in the stock market so far in 2016. What is that telling you? I'm looking at all the articles. There's a lot of indicators out there that are saying that we peaked and we're due for a crash like in 2008, maybe even worse. So are we close to another bust in the market?
Well, it is. We certainly have that potential, right? I think there's been a lot of talk, I'd say, in the last month that inflation is starting to pick up. Commodities have bounced, and they're starting to bounce up a little bit. Growth perhaps is not as negative or as low as people had, previously thought. But, I kind of disagree. I think the prevailing trend in the market now, in the economy, I shouldn't say the market, in the economy is deflation, right? And I think we got to separate out the market and the economy. If you look at the economy since 2008, it hasn't expanded that much. Growth has been very subdued. There's been many quarters where GDP has been negative. Unemployment has come down, but it's been characterized by low-paying jobs or part-time jobs. And so, the stock market has gone up tremendously, but the economy itself hasn't. And when you hold interest rates at, 0 or 0.5 or basically 0 for 5 years, that's it's not only not any growth, but it's a recession, if anything, and potentially even a depression, right? And so now we've gotten to a point where, people are realizing that all these programs that they've enacted, and we still have very, very subpar growth. So much so that, some of the central banks around the world are already instituting negative interest rates. The U.S. raised by 25 basis points in December, and it almost caused, another big meltdown. So I think that, the economy itself is headed towards a recession. Whether or not that pulls the stock market down, I think will depend on what the central banks do. I don't think that they're going to sit by and let it happen, but I also don't think they're going to come out with a lot of new programs until it does. So I do think that we're probably due for a correction. I think we're probably due to have a recession this year. My question comes, what do the central banks do when that happens? How negative do they go? What size of a new, what's the new program that they roll out to counteract it, et cetera, et cetera. So, I think you just look back at the charts of the equity market over the last 7 years, and anytime the central banks have been providing stimulus, the markets have gone up. As soon as they stopped the stimulus, it petered out and started to come back down. And so, that's kind of happened for the last year to 18 months in the stock market. It's basically been flat, and it's, sold off here in the last couple months, and we're kind of testing some strong support. I think a lot of what caused, the volatility so far this year has to do with China, the potential devaluation of their currency that might have to take place. How much are the outflows? How bad is the deflation in China, and are they going to be able to counteract it to keep the flow of funds from leaving China too quickly? Because if the flow of funds leave China too quickly, it's going to put a lot of pressure on their currency to drop lower, and that pushes deflation out into the rest of the world. So, I see a lot of deflationary pressure still in the market.
And a lot of people look at the stock market as a reflection of how well or how poor the economy is, which is further from what's the truth. Because you look at the stock market the past couple of years, and it's gone up and up and up, but that does not necessarily mean the economy is doing well. Just got to read between the lines, look underneath the surface of the stock market, and find out why it's going up and how. And I think a lot of people fail to do that.
Yeah, I agree, and I'm always surprised at that, right? And even my friends who work on Wall Street and the people I talk to, these very very successful, very well known, very respected firms, they take like the top line number and they accept it and they extrapolate it, and even though they're smart enough to look under the surface down into the details, that they just really don't. If they can spin the popular narrative based on the top line number, they will do it all day. And if they get challenged on the details underneath it, they always have an excuse to explain it away. And the number one excuse that I get is, yeah, that's a problem, but if growth picks up, it'll take care of itself. Yeah, that's a problem, but when growth picks up, it'll be fine. Yeah, that's a problem, but when inflation gets back to 2%, it'll be okay. And I would say, but there's a big but. There's not that much growth out there. Now, credit expansion might happen due to central bank policy, but as far as organic economic growth in the world, I just don't see it.
Yeah, I mean they're getting the nice bonus check, so I mean they're not going to complain.
No.
Right.
And the other part of it too is I should explain this. I take a lot of pot shots at typical Wall Street, and central bankers are always on my hit list. But the reality is a lot of these firms, they're not made up of evil people, and I think they kind of get personified as these big evil firms. And I'm not saying some of the people aren't, but there's a lot of people at these firms that they're good people. They've got mortgages, they've got kids, they just want to go to work, they want to make a good living. And don't get me wrong, they make good living, but they're not out there trying to purposefully screw anybody, right? Now, at some levels it does happen, but by and large, a lot of these people, they just don't even realize it, right? They don't realize that they're part of the system. And so when I kind of take shots at Wall Street and stuff, and I kind of speak in generalization, you know, it's not that everybody that walks into Morgan Stanley on Monday morning is a bad person. It's not that everybody at Goldman Sachs is a bad person. It's just that the incentives there are all wrong. You know, the incentives are there to make money for the firms first and make money for the clients second. And well, they want to make money for their clients, but only if they make the money first, right? And the incentive structures that are set up for them to have a good career and get promoted and move up the ladder are such that they need to make revenue for the firm, and that revenue comes from clients. And that's just the bottom line.
Yeah, and I agree with you. I have friends on Wall Street as well, and they're great people, and they're trying to, you know, move up the ladder and have a productive career and be productive members in the company they work for. And I agree. Not everybody in Wall Street is bad people. Just the system is the system is bad.
It's a bad system. It's a bad system.
Yeah, I agree. I think people, when they think of Wall Street, they think of like the movie The Wolf of Wall Street or the movie Wall Street with Michael Douglas.
Yeah.
The
and
people
those guys
out there.
Do exist. Don't get me wrong. Those people absolutely exist. It's just that not everybody's like that. That's my own.
Yeah, I agree. So let's talk about the precious metals market. So far in 2016, gold is up 19%. Silver is up about 12%. So far this year has been a pretty good year for the precious metals market. Is this the year where we enter a new bull market in the precious metals market?
Well, you know, I really think that the next 6 weeks are going to decide that. It certainly looks pretty good. And the reason I say that is because we had a similar dynamic in early 2015. If you look back to 2015, in January, I think gold was up 9 or 10% in January of 2015. The miners were up, I think, 30%, maybe more in January of 2015. Silver was up a similar amount. But by the middle of February, it had turned back down, and kind of by the end of February, I think most of the gains had been given up, and then, you know, we kind of went into kind of a pretty volatile year the rest of the year. Now, this year has been a little bit different. It's lasted longer. It's gone a little bit higher. We've had a lot of positive physical gold flowing into the ETFs, which has not happened since 2013. We've traded above some long-term moving averages. That hasn't happened since 2013. So and you're starting to see more flow of funds from kind of the bigger institutional investors starting to come into the gold space. So all of that is pretty positive. And it seems like it's a little bit more long-lasting and a little bit more solid than it has been in previous years. The one thing that concerns me a little bit, or I guess the biggest concern that I have when I look at the precious metal space is, number one, the commitment of traders has started to get a little bit more bearish here in the last couple of weeks. That's not surprising, given the level of appreciation that we've made. And the other thing is that silver is lagging both gold and the miners. And I think when we get into when we return to a true bull market for both gold and the precious metal space in general, I think silver should be outperforming, and it's just not yet. And maybe it just has some catch up to do. But so far, you know, if silver was at $18 or $19 rather than $15, that would make me much more comfortable with where we're at. And maybe this is just an effect of, you know, the bear market has gone on so long, I'm a little bit jaded. But I do think we probably put in a bottom in December. I think that there's a lot of positive catalysts right now. Like I said, one of the main positive catalysts, I think, is that this talk of negative rates. You know, if you look back at both gold and the miners had a big sell-off. I think it was like January 18th or 19th. Had a kind of an outside reversal day to the downside, but then immediately bounced back the next couple of days, and that coincided with the Davos World Economic Summit. And one of the big themes that came out of that Davos was that the proliferation and the ability of central banks to go negative rates. And you started seeing more conversations in the mainstream about the banning of cash. And the thing is the negative rates and the banning of cash, they go hand in hand. They're kind of two sides of the same coin. And I think people are starting to realize that they are seriously going to go negative and go negative aggressively you've got to do something with that money, or else it's a tax on savings, basically. And a natural beneficiary of that is gold. So there's a lot of positive catalysts for gold. And I don't want to sit here and be a Debbie Downer by any means. I'm very encouraged by the signs I'm seeing. But I do think that the next kind of 4 to 6 weeks are going to be very important. Over the next 2 weeks, we've got a lot of central banks announcements. Going back to the currency wars, you could see some big fluctuations in the dollar. I happen to be somebody who thinks that the dollar's strongest days are not behind it. I actually think the dollar's going to get much stronger in the year ahead, or in the years ahead. And I don't necessarily think that's bad for gold. In general times, a strong dollar is negative for gold. It doesn't have to be bad for gold. But I do see a scenario where we could get into a spiking dollar scenario, which could temper gold's growth in the short term. Now, in the long term, it's actually the strong dollar, which I think will bring down, the global monetary system, and that is what will lead to gold's ultimate strength. Because I think a strong dollar kills the ability to expand debt in the world. So I'm probably a little bit different than most people in the gold world on that. I think most people in the gold world are of the opinion that the dollar is going to get weaker. Inflation's going to pick up. The dollar is going to lose all value, and gold's going to go to $10,000. Now, I can see that happening, down the road. But I think for that to happen first, I think the dollar has to get stronger. So I think I end up at the same place as the people who believe that. I think we just take a few different roads to get there. I kind of rambled there a little bit. I hope that was coherent.
Oh, no, that's okay. And you mentioned the gold ETF. Well, I just found out that the two largest gold ETF, GLD and IAU, have seen $7.1 billion in new net demand so far this year. Now, this is not ETF. I would recommend people buying and holding for gold, but that those kind of numbers are very bullish for the gold and silver market.
Especially if it continues, because and many people have pointed this out, is that there's been this mass migration of physical gold from the U.S. and Great Britain through Switzerland to back to China and other, Asian countries over the last couple of years. And there's no doubt that has taken place. And a lot of that supply has assumedly come from the ETFs losing assets, right, or losing physical gold. So if that demand continues in those Asian countries, China, I think imported over 2,000 tons of gold again last year. I think total global production is, between 2,500 tons and 3,000 tons. So they're making up almost all of the global gold demand. If that demand continues out of China, and then the ETFs in North America and Europe start to want gold as physical gold as well, where's that gold going to come from? That is the $1 million question: is where's that gold going to come from? And if it's not sourceable at $1,200 an ounce, it might have to be $1,400 an ounce or $1,500 an ounce to get it. And so, I think watching the flow of funds in the ETFs are critical to the whole supply-demand characteristics of the gold market.
Yeah, and I've been watching a lot of other indicators, like the premium on the gold and silver coin. Now, right now, the premium for the gold coin is $52 over the spot. Last year it was a lot lower, probably around half that amount. The sales for the gold coin had doubled since last year. Yeah. And then for the silver coin, they're on track for an annual record, and already they're up by 25% at the same time in 2015. So, the indicators are all there for a good year for the precious metals market.
Well, that's probably been the biggest conundrum of people trying to get their head around the gold market for the last couple of years, and why it's been so, I guess, frustrating on one hand to see it go down is, the supply demand characteristics seem to be that, the demand for gold is still there on a global basis. Now, there's been less demand in the West, but it's been made up for by, increased demand in Asia. And over the last couple of years, demand for coins, both in Asia and in the U.S. and Europe, has been very high. So there's the difference between the physical gold market and the paper gold market has led to this big, debate of which is the true market. I would argue that the true market is the physical market, but so far the price is still set on the paper market. And, when those two finally, I guess, for lack of a better word, converge, we'll perhaps get a better assessment of where price should really be.
Now, one last thing before I'll let you go. Let's talk about the gold and silver mining stocks. So the downside of investing in gold and silver mining stock is a lot of volatility and a lot of hit or miss, especially if you try to buy the junior and exploration companies. Then many complain the volatility and they cannot, handle the risk. So do you think Main Street investors should jump into mining stock now? Should they wait until the uptrend had been solidified?
I think it really all depends on everybody's individual situation. So I always hesitate to give general advice in a talk like this. But in general, I think I cannot think of a situation where somebody should have zero gold in their portfolio, right? Now, perhaps you don't need to have 25 or 30% of your portfolio in gold. But I have a hard time understanding why anybody would not have at least 1 or 2% of their portfolio in gold, right? And I happen to believe it should be much higher than that, but there's probably scenarios where 1 or 2% is plenty. But the answer is certainly not zero gold in your portfolio. I guess the second place I would take it is that, if you don't have any gold in your portfolio, the first thing you should do is get physical gold. To me, that's the anchor of any portfolio, right? And then from there, if you've got, I don't know, whatever your core holding in gold is and physical, and you want to, take a step further from there to actually get some turbo on the upside prospects for gold, maybe you start, venturing out into the gold mining stocks. Now, if you think gold's going to go up, then you should buy gold, right? Because gold can go up and the miners can go down, or gold can go up and whatever individual miner you buy could go to zero, because there's a million of these little gold companies out there that are never going to find an ounce of gold, or they might find a huge, reserve of gold, but not be able to exploit that asset or get it out of the ground at an efficient price or whatever. So, once you start venturing out into the mining space, it's a whole new ballgame. So I think the first place I would go into the miners is kind of the majors, the places that have, proven reserves. They're actually already producing gold. They have a history of producing gold and a history of operating. And hopefully over the last couple of years, as we've been in this bear market, they've stripped out all unnecessary costs, et cetera, et cetera. Another place that you could go in the mining space that has maybe a little bit less risk than, a typical mining stock, but also perhaps a little bit more upside than just gold itself would be the streamers, the royalty companies, where they're not actually going out and they're buying a percent of the resource that has already been found, and they're getting a royalty for providing, capital to those companies to do that. And then if you want to take another step out from there, you can start going into some of these, junior mining stocks that are perhaps exploring. Again, that's much higher risk, much higher reward, but, that's the way it works. You're not going to get the huge return, without taking risk. So it's got to be structured appropriately in a portfolio. But I think there is a place in everybody's portfolio to take some risk somewhere. And if you have, the expertise or the ability to get the right advice to take those kind of positions, then I absolutely think they have a place in a portfolio. But what I think we're probably going to see, and people have been talking about this for a couple of years, and as we've remained in this bear market, we haven't seen, but we're going to start to see some consolidation in the mining space. You're going to see some of the majors start buying some of these, smaller companies that are maybe they found a deposit or they're trying to find a deposit, and you're going to get into an M&A kind of boom, so to speak, within the commodity space, specifically in the precious metal space, where you can really get some very large upside in some of these small mining companies. We saw a deal earlier this week where Lundin acquired an interest from Freeport in one of the reservoir minerals projects. And my guess, I don't have the details on it, but I'm guessing that they've been probably looking at this project for the last year, 2 years, trying to negotiate it in a price, and Reservoir Minerals was probably holding off on selling because they didn't want to sell at a depressed price. But now, with this pop we've seen in the mining companies in the last 2 or 3 months, some of the majors probably don't want to wait any longer for it to pop anymore, and they're probably going to start buying some of these companies while they still can at a price that they can afford before we get too much of a move to the upside. So, there's definitely some positive developments in the arena. And, I guess, again, on a general basis, I'd say that there is a place in everyone's portfolio for gold and gold mining stocks, but you just got to be very careful how you do it.
Yeah, and like you said, if you believe in math, buy gold and gold stock.
Yeah, I mean, that's exactly. You kind of got to know what you're getting into. You got to know your time horizon. You got to know why you're getting into it to begin with. But if you understand all those things and you believe in math, you should definitely buy gold, because the way the system is designed from a mathematical perspective, one of two things has to happen. It's either going to crash or they got to inflate it to the moon. And if you've got the time to stay the trade under either scenario, gold and the gold mining stocks should do very, very well.
Okay, well, thank you, Brent, for your time. If people want to find out more about Santiago Capital and your work, where can they go?
You can go to www.santiagocapital.com. You can also just send me an email at brent@santiagocapital.com. Feel free to call me, shoot me an email. Happy to talk to you. And I really appreciate you having me on today, and happy to do it again sometime in the future.
Yeah, definitely. We'd definitely like to have you back on. Thank you, Brent. Thank you for your time.
Absolutely. Have a great night.